Vaibhav is the Chief Investment Officer at Teji Mandi. He comes with a decade of experience in stock picking and generating index beating returns. He's grown up under the guidance of ace investor Mr. Ramdev Agrawal, and his style of investing involves combining a portfolio of tactical bets with long term winners to generate optimum returns. Weber holds a Bachelor in Computer Science from the University of Pennsylvania and an MBA from London Business School. The team at Teji Mandi believes in empowering investors with advisory and education in order to achieve their financial dreams. And the, they are currently available both on their own app and the small case platform. So, with that, let me welcome Weber. Weber, we're very pleased to have you.
Thank you so much, Krishna. Pleasure to be on today's Twitter Spaces.
And along with me, Sahir will also be co-moderating this session. And the focus.
Lovely to have you here. It's an honor.
Yeah, thanks, Sahir. Honor to be talking to you as well.
Okay, so before we get into the topic, which is today's, which is small and mid cap investing, Vaibhav, can you tell us a little bit about your journey in terms of, when was it that you actually made your first investment, and what were the initial years of investing like? You had the mentorship of Mr. Ramdev Agarwal, but I'm sure you still made a few mistakes of your own, and you had a few insights and learnings along the way.
Yeah, so thanks for that question. So I sort of started investing around 2007 or 8, if my memory serves me correct. And at that point, I was actually sort of doing my internship in sort of research in one of the research houses. So at that point, I invested in Nestle, and at that point, Nestle sort of was not as richly valued as it's today. So it had done well at that time. So what happened was I invested in Nestle and Grew Finance. Grew Finance is now it's a part of Bandhan Bank, but back then it was a up and coming housing finance company promoted by HDFC. So these are the first two investments. I think they did reasonably well. I think one of the mistakes I made is I sold Nestle and Grew Finance early on. And I invested in another company which was sort of not so great. I think a lot of people here wouldn't even recognize the name today, but that company had sort of sold their operating business and all of that. So I thought that the company has cash of I think 5 or 6,000 crores, and the market cap was only 1,200 crores. So in that mistake, I sort of invested in it, and that sort of went nowhere. So I think that was one of the mistakes I made. That when you have great businesses and you bought them at reasonable valuations, you should stick to them.
So, yeah. That's already a fascinating insight for our listeners to take away. That cash on the balance sheet is not as important as the current operations of the business. So I want to also step back a little bit and ask you for a more sort of broader perspective on, do you think that mid cap and small cap stocks have their own business cycle which is distinct from that of the large cap companies?
See, I don't think small and mid caps, are aliens to the economic system. I mean, they're very much a part of it. But what happens is that for small and mid caps, the effect of the cycle is more accentuated than it is for large caps. Large caps, by their nature being larger, are more stable and more sturdy. So in an up cycle and down cycle, they tend to remain, more neutral. Small and mid cap, if it's in a down cycle, it gets hit harder, and if it's in an up cycle, then sort of the swing is also much larger. So I think that's how I look at it.
So Vaibhav, so often in small caps and even mid caps to some extent, to grow, companies use internal accruals, of course, but they have to raise significant debt and even dilute equity in a lot of instances. So how do you look at this scenario where companies raise a lot of debt and dilute equity in these small and mid caps, which might not be prevalent in large caps?
I don't think that that's necessarily true that that large caps don't dilute money. I mean, you must have seen like a lot of banks, for example, large banks raised a lot of money last year.
Yep.
In
Airtel,
fact,
stuff like that.
yeah, in fact, large caps have much. They have greater access to capital in the money markets. But in small caps, I think if they're raising debt now, I don't think you can say that one decision is good or bad. You have to look at the context of it. So if a company is raising capital to grow, or it's raising debt to sort of in sort of future capex for future growth, then I think in the context of that, it could be positive. But if they're doing it for other purposes, then maybe you would have to sort of look at it with a finer eye.
Keeping with this theme of debt, um, especially in the mid and small cap space, do you see more value since we are still early-ish in the cycle, and the structural bull market should continue for the next 3 to 4 years? Do you see more value in debt-heavy companies that are deleveraging, or do you still want the companies with a debt-free balance sheet, even if margins don't have a lot of scope for expansion?
So I think, yeah, I mean, I think you're right. The cycle. So India. So I mean, I think coming to the cycle, I think it's important to understand that like the last decade for India was sort of a lost decade as far as corporate earnings were concerned. And there were several things like the demonetization, RERA, and even like the INFS crisis, because of which the entire economic system was hit. So I think India is coming out of three large sort of down cycles in real estate, corporate earnings, and the NPAs of banks. So now that we're entering into a three like a structural upcycle in three of these important sort of areas, I think small and mid caps will sort of do very well in that. And in some cases, like because interest rates are sort of accommodative right now, so if companies raise some debt for future expansion, I mean, I think that could be creative for them from an ROE perspective, but and growth perspective. But we have to see that sort of in context. So I think it depends from company to company. Can't sort of give a one size fits all answer for everyone.
Thanks for that in-depth answer, Vaibhav. So I have a question related to small caps specifically. So how small do you look at for like small caps? Is there a minimum size? Because a lot of institutions they don't go beneath a certain market cap. Do you have a criteria? Do you have a minimum market cap or a minimum size, or are you agnostic to that?
So I think I mean we do look at the free float and the liquidity available, and specifically for small caps, I think we rarely. I mean, in very certain, in only in certain cases, we might go below 2,000 crores of market cap. But otherwise, largely, we play like we're more comfortable in like the 4 to 5,000 crores of range, and all the way it goes to 30, 40,000 crores. So I think your free float and promoter holding also plays an important component, because if I mean, let's say you're attracted to a small cap, mid cap stock, and if it doesn't have enough free float liquidity, then you could be stuck on the wrong side. It becomes important to see that as well.
Yep. Agreed. Krishna, do you want to go next?
Yeah, yeah. Interesting point about the free float, because it's only something that you really need to think about when you're looking at companies under 5,000 crores. But let me ask you about two other metrics when it comes to picking small and mid cap. So you spoke a little bit about how it depends when it comes to the amount of debt that those companies are carrying. Um, how much debt are you comfortable with in terms of the debt to equity ratio, and sort of in conjunction with that, even although not directly similar, when you're valuing small and mid cap companies, how do you look at the PEG metric? Do you find that it's useful? Because there seems to be a lot of debate around whether it's useful as a metric or not.
So I think I'll answer the PG question first. So I think see PG is it's more of a heuristic metric, which means that it's more of a guiding tool. It is not an absolute sort of tool by itself, right? So you cannot select a stock just because it is below one peg or half peg or whatever it is. I mean, it's just a sort of a useful rule of thumb sort of this thing, just to give you some sense of what the valuation looks like. But obviously it's a very simplistic metric to sort of just buy a company on. So I think if you use it as a rule of thumb, then it's fine. But obviously, by no means that can be your final metric to buy a stock. And I'm quite. And what was the second question? Sorry, I think I missed
The,
that
the
one.
second question was around the debt to equity ratio. How
Yeah,
high are you
yeah. So
comfortable?
so most companies for us are below one. In some cases even below zero point 0.5. I think in rare situations where a company is sort of coming out of a, I mean, if it's sort of in an upcycle and it's coming out of a bad patch and going into a purple patch, then at that point maybe like a high debt company going to low debt company can also be a reasonably good value creator. So to see it in that context.
Cool. Sahir, you want to go next?
Yeah, got it. Um, so how do you? So moving from debt, how do you look at cash flows, free cash flows in these small to mid caps? And also, how do you view working capital? Is it different from industry to industry? Is it different according to the size of the organization? How do you basically view cash flows and also working capital?
So I think cash flows specifically, I think in India because I mean companies are growing quite aggressively. I think you don't see free cash flow sort of very often. I think recently, if you had seen like the steel companies had gone into a free cash flow status after almost I think 6 or 7 years. I think it was a pretty long period. So I think free cash flow, at least in a country like India, might suggest that maybe the company's growth is sort of behind it. So I think that's how I would view free cash flow purely. But if the operating cash flow is strong, because the operating cash flow and the earnings sort of have to have some sort of reconciliation. So, but I think earnings also often is sort of a good indicator. I mean, you obviously have to be careful because in small caps and mid caps sometimes promoters tend. I mean the financials can be sort of you have to look at it a little more deeply to make sure that there's no sort of manipulation or jugglery. But I think by and large, if you stick to the main sort of good frontline reputed sort of companies, then I think that sort of issue is taken care of. So I think earnings growth becomes important. And I think your second question was around
Working capital.
yeah, working
Yeah.
capital obviously differs from industry to industry. So if you take capital markets, so like some of the broking companies like Angel Broking or ICICI Securities, I mean they don't need capital to do business. They're pure free cash flow machines. Whereas if you go into a sector like maybe cement, their ROEs are only maybe 15% or below. So you need to keep doing capex to keep sort of growing. So I mean, obviously, working capital requirements then sort of keep changing from industry to industry. And even the receivable cycle. So, if, for example, if some companies are dealing with the government, receivable cycles tend to be quite lumpy and long. So, I think that's how it kind of changes.
Makes sense. Before we continue, I just want to remind the audience that at a later stage we will be moving into Q&A, and if you are a regular here, then you can request from now only to speak. And if you are somebody who's new, then please either DM Sahir or me your questions. The ones who message us first will get preference. In the Q&A order. So, Vaibhav, you spoke a bit about earnings growth. You spoke a bit about debt. So, just to bring the whole thing together, um, what would you say? Debt, earnings growth. What would be the other two or three things that are most important when you look at valuation for small and mid caps?
So I think specifically for valuations, one, you have to see what is the return on equity and the dividend payout, because that sort of determines that's a determinant, one of the determinants of the P ratio. And second is, I think in terms of I think in terms of relevant sort of you have to see like what percentile of it sort of P ratio it's in. So is it in the bottom quartile, top quartile, or what? So that way I think it's sort of because that will sort of indicate that compared to its own sort of valuation history, where does the company stand? So I think these could be two useful metrics for people.
Can you just clarify a little bit about what did you mean by the quartiles?
So supposing like every company has a trading band, right, for the P ratio. So it could be that uh, at one point it traded at say 20x earnings, or it traded at say 50x earnings, and right now say it's at 40 times earnings. So you can get a history of the company's P, like the P chart. Just like you have the price chart, you also have the P chart, and then you can figure out that at what point of its history, like if it's traded, say the minimum is 20 and the maximum is 50. So at what point? I mean, at what percentile of that it's in? So I think that sort of gives you a good sense.
Cool. So basically, relative to its historical valuation.
Yeah.
Sahir, you had a question?
No. So yeah, I just wanted to know. So do you mean like you look at median PE in some sense, and you look at mean reversion? Is that with respect to PE? Is that a good way to look at it? I
Yeah,
just
no.
wanted
So
some clarity on. Yeah.
yeah, no. So this could so let's say that the company so the median would be like the 50th percentile, right? So what it means is that the current P could be either above it or below it. So a median P is like just the historical sort of average or median. But what you have to look at it is that like at what point uh, is it in? So like 50th, when you say percentiles, it means like you're dividing it into four chunks of 25, 25 each, right? Median is like the middle layer. So is it above it or is it below it? Is it close to the minimum that it's ever traded at, or is it close to the highest it's ever traded at? So I think that's what I meant to say.
Got it. Got it. So how would you look at this conundrum with like a lot of companies trading at obscene valuations, like way above median PE? PE, picking PE as the basic metric, but like way above it. Uh, but they seem to have a long runway for growth despite trading at those obscene valuations. So how do you view this conundrum? Like, at what point does it become too obscenely valued, and at what point is it like at for how long can you ride it? Like, how long can you ride the overvaluation, and at what point do you stop? Like, hey, this is way too overvalued.
No, so see, valuation also, I think, like to call something overvalued, I think, I mean, again, it's a relative term. So if you look at sort of the mid cap and like mid cap, small cap index, it's only 10 to 15% higher than what it was from the 2018 peak, right? And India had sort of corporate earnings growth of only 3-4% in the last whatever 7-8 years. So I think next at least 4-5 years estimated is about 15%. Next 2-3 years is going to be even higher than that. And if that happens, then I mean, I'm talking about Nifty EPS growth. So if Nifty EPS growth is like 15 to 20%, small cap, mid cap EPS growth is much higher than that, right? So in that sense, it could be the case that if you look at something, say from a 3 to 5 year horizon, then maybe it might optically be looking high right now. Also because earnings have been very sort of choppy because a lot of things have gotten disrupted in the last sort of couple of years. But so you have to look at it in the context of that. So I mean, I think that it could be the case that something that's like looking optically high could in fact have strong sort of earnings growth potential and strong even capital appreciation perspective. But again, operating on the edge always comes with its own risks. That's why you should have some margin of safety. So ideally, if the company is trading at say, as I said, like the 60th or the 70th percentile, not at the 99th percentile. So if it's like, say, at least a few notches below the peak, then I think at least you have some sort of margin of safety.
Interesting. This concept around margin of safety is quite interesting, and just trying to apply that lens that you just spoke about in terms of earnings growth. Like, if we took that and we applied that to the electronics contract manufacturing sector, which right now is probably seeming like at eye-popping valuations, but then the kind of earnings growth that this segment is going to see over the next 18 to 24 months visible is quite high as well. So how would you apply? Would you say that that sector has any margin of safety, or is completely eroded because everything is sort of baked into the price?
You mean like like when you say electronics contract manufacturing, are you referring to companies like Dixon and Amber?
Yeah, absolutely.
Yeah. So yeah, I mean, I think like if you take both those companies, like if you take for example Dixon, um, I mean, like basically that's an industry that is sort of going through a 0 to 1 sort of a phase, right? I mean, India has never been a hub for electronics manufacturing, but now because of the government impetus and all of that, and a lot of companies also looking at sort of diversifying their manufacturing base outside of China. So I mean, like for a player like Dixon, I mean the opportunities could be quite meaningful in the times to come. So at that point, I think maybe PE may not be uh, the right metric. So if you look at the PE of Dixon, I think it's like close to 166 or something, uh, and even Amber is at some funny number. But also I think for a lot of these companies, the earnings have also gotten disrupted because of COVID issues. So I think you have to look at the opportunity size. In context of them, and then sort of see where the valuation or market cap stands at.
Makes sense. So this 0 to 1 moment is quite interesting, right? When you apply that 0 to 1 framework in terms of a sector like textile, where would you say we are? Because we're not at 0 and we're not at 1.
Uh, I mean, textiles. I think again, like there are many different parts of the textile value chain. So I think recently, like one textile company that did very well was Trident, right? And they're big on the home textile space, and so is so. I mean, I think like something like home textiles, for example, is an interesting sort of segment of of the textile industry. Then you have like branded undergarments, which also, I mean, there are 2 or 3 interesting players there. And then you have like some of the yarn manufacturers. So I think textiles in general has been a very cyclical industry. I mean, historically, India is probably one of the largest sort of manufacturers and exporters and even employers of people in the textile space. But I think you have to find companies that sort of have good return on equity, good capital allocation. So I think that you'll find those companies mostly in these sort of pockets of it. So I think that's where I would look at. So that's it. So I think the textile industry is at a good deal of maturity. I mean, maybe the exports could increase, but yeah, I mean, it's somewhere between 0 to 1.
So, Vaibhav, you're talking about the 0 to 1 framework. A similar question along a similar path is what are your favorite mental models? Do you have any mental models that you follow rigorously or that you use in your stock picking?
I mean, so I think one of the ones I think we had sort of addressed earlier, which was margin of safety. So I think like that is a so if you have margin of safety, and I think if you like look at the power of compounding, I think like one is like you sort of you have an intellectual sort of an understanding of it. That's one, but when you like really go through it experientially, and then you understand it at that level, and you can actually practice it, because in these understanding the concept is I think like 10%, but 90% is actually applying it. So if you're able to do that, I think more or less, I mean, I think you should do reasonably well in the capital markets.
Got it. And a similar and a question, because you mentioned that the textile sector is a cyclical sector. Do you play any other cyclical sectors? Do you invest in any other cyclical sectors?
So I mean, again,
Whether
like the
shallow cyclicals or deep cyclicals, whichever, any of the so.
I mean, see, I think at one level, every industry goes through different cycles. But I mean, if you were to take, I think right now, for example, like it's again hard to give that, to generically say that, this is the sector. But I think more specifically, I think, given that India is sort of coming out of a, like a sort of a down cycle and going into sort of a structural upcycle. Like some companies, especially like in the housing or in the infrastructure space, or even like like industries which are ancillary to these two sectors. So there are some sort of interesting opportunities there.
Got it. Got it. Krishna, do you want to go next?
Yeah, yeah. So you spoke about cyclicals and how it's each business has its business cycle. So relating to that, where would you say we are in terms of infrastructure? Because it's not a business that a lot of people who've come into the markets in the last year or two have either heard any narrative about or have in any way participated in.
No, I think the narrative for infrastructure has been there, right? I mean, the government had sort of announced the national infrastructure pipeline. I think it was almost 5 or 6 lakh crores. Then I don't know, some fancy number like that. And then they had also talked about government spending in the budget as well. So in fact, I think infrastructure and government capex and private sector capex, I think it's been a story which is sort of I mean, at least the the signs of it have been there. I think it's sort of early. It's yet early days for that sort of theme and sector to sort of play out. But I think the underpinnings of it are there, and I mean, there are different ways to play it.
Are you playing it in any way?
Yeah, that's what. So I had mentioned, right? Like there are some players who are either directly in the infrastructure space or in segments which are ancillary to the infrastructure or housing sort of sector.
Yeah, understood. So it's something that could play both the infrastructure and the housing boom sort of
Yeah,
together.
yeah. So, for
Cool.
example, I mean, just to give you an instance, like for example, if infrastructure and housing does well, then cement companies are likely to be a beneficiary of it. If housing does well, then a lot of the ancillary home players like electrical cables, electric wiring, then even like the tile manufacturers, a lot of the faucet manufacturers. I mean, so those sort of ancillary industries tend to do well. So, like that, I mean, you can play this theme in many ways.
Absolutely. And just for me to get a sense, two questions about this. One, I've heard you speak about the core portfolio of long term growth companies and the tactical bets portfolio forming your flagship product. Is it the same when it comes to picking small and mid caps?
Yeah, so small and mid caps, I think it's more actually the long term growth. We don't look at tactical opportunities there. That's sort of a much longer term sort of outlook that we have. Because for these companies to sort of create wealth, I think you sort of have to own them for a period of time for them to sort of meaningfully be valuable for you.
Makes sense. Makes sense. And how do you look at allocation within your portfolio? What's the minimum allocation you'd give to any stock, and what's the maximum allocation that you'd give to any stock?
I think max would be 10% and minimum would be 7%, at least in the mid cap, small cap portfolio.
7% for the minimum.
Yeah.
So it's a highly concentrated portfolio then.
Yeah, I think so. I mean, it's so. I think we have a portfolio of about 14 to 15 stocks, and I think that beyond 15 to 16 stocks, I think the point of diversification also sort of plateaus out. So I think the diversification is optimum, and it's obviously high conviction because sort of you're looking at sort of companies of that caliber. So uh, having a high conviction portfolio sort of makes sense over there.
Cool. I have two last questions, and then we'll take questions from the audience. My first question is, um, do you have any sort of sectoral caps on the weightage that you would assign companies? So like 25% max for pharma or 25% max in total. That's the first one, and the second question is around you know, looking for downside protection when small and mid caps are not doing well. For example, 2018, 2019. I don't know if your mid and small case product has existed that long, but I'm sure like you'd have the perspective since you've been in the market for so long. So in periods like that, what would you do? Would you change your portfolio for capital protection in any way?
Right. So I'll take the first question. I think which was around. Sorry, can you please repeat the first one?
Yeah. So the first question was around sectoral caps.
Sectoral caps. Yeah, yeah. So this is a more bottom up sort of portfolio. So I mean, sectoral caps usually. I mean, given that it's a reasonably sort of concentrated portfolio, no one sector sort of contributes more than 15 to 18% at any given point in time, because different stocks sort of represent different sectors. So, I mean, we don't have an explicit cap, but in practice, it doesn't sort of go beyond that. And the approach is much more bottom up for this than top down. And in terms of the second question, that if sort of things go wrong, then what will we do with the small and mid cap portfolio? So I think again, so the thing with small and mid caps is that until and unless like something really untoward doesn't happen in the markets, where like there's a complete global externality, or it's like extremely overheated, or we think that something can go fundamentally wrong, like it's unlikely that we'll sort of have, or we'll sort of allocate a portion of the portfolio to liquid ETFs or cash. But in cases where where it's very clear that there is something that can sort of distort the portfolio, then at that point, as a risk mitigation mechanism, we could look at some liquid ETFs just to cushion the volatility that might happen on account of that. But given like by its nature, because this is a portfolio that sort of looks at companies to compound, I think we sort of choose to remain more fully allocated.
Awesome.
Weber, one last question for you. How do you assess management, and how does one assess management, say if he or she is a retail investor and hasn't got access to either meeting the management, and maybe even if maybe like a small cap company that doesn't even do con calls? How does a retail assessment? How does a retail investor assess the management in that case?
So I think you have to look at some financial ratios, like so one thing would be like ROE. So you have to see like, is the return on equity upwards of 14 or 15%, because that sort of is an indication of the efficiency of the company's management. Then you should see that do they have like sort of too much what do you call that, unsecured loans, that maybe some of the company sort of promoter group may have parked in the company. Then you can also look at, for example, like companies like revenue might be increasing, but receivables are also increasing, and those receivables are not translating into sort of cash flow. So at that point, it could be that maybe the company is maybe like accounting or sort of overstating revenue. Then I mean, I think you can also go to the value picker forum. I think you have some great sort of threads there in terms of what on different companies some investors might have some views. So I think these are some of the ways in which you can sort of look at things.
Got it. Thank you. Go ahead, Krishna.
Yeah, we have our first speaker. Uh, I think he dropped out. We also have one question in the DM, so I'll give you that one first. What are the spaces right now where what are the sectors right now where you're seeing most value in small and mid caps?
So in terms of sector, I think some of the capital market companies are, I think they're free cash flow machines. I mean, and there's a long runway for growth ahead of them. So that's definitely one low hanging fruit. Then as I mentioned, I think we're coming out of three big cycles in banking, real estate, and infrastructure. So that could be sort of one big sort of area to look at. And the other ones, would probably be like in the IT space. So, like a select sort of set of IT names could also be very interesting. So yeah.
Cool, thanks. Next we have Cindy Chokro, but before that, guys, please DM me your questions. If I don't have a request and a DM, I can't pull you up. Go ahead, Cindy.
Hey, hi Krishna. Hi everyone. Thanks for the opportunity. Hi,
Yeah.
Vaibhav. Hi.
Yeah.
Okay. So I know there isn't any instrument available to hedge particularly mid cap and small cap portfolios, especially with the volatility they have. So I mean, do you have any other way where we can, at least protect the downside when it comes to such volatile portfolios? Like Nifty is in, like these guys are introducing Nifty mid cap index or derivatives on Nifty mid cap select index. So, your thoughts on it?
Right. So I think like if you look at the small case portfolios, these are sort of long only sort of long term portfolios, right? So I think in that sort of context, I mean, if you have your own prop book or something like that, or another vehicle where you can sort of use instruments, I think that might be easier. But specifically in the context of small case portfolios, I think the only available tool at that point is that like you have to have a part of the portfolio in sort of liquid ETFs, or maybe have some sort of very low volatility sort of bellwether large cap stocks. I think because at that point, usually if you see even in a downturn, I mean, even if you take the recent example of 2020, um, if you have decent names in your portfolio and they correct sharply, they're usually also the first ones to bounce back, and to sell at at that time when they're correcting, and all of that usually. I mean, until and unless like you're caught in a complete down cycle, and it usually if you sort of take a hindsight view, then it's usually not a good time to sort of sell them. So I think it's not such a straightforward sort of a problem. I think you have to look at it in the context and then take a call.
Okay, if I can add, Krishna, I can have one small question.
Sure, go ahead.
Okay, so you got to understand that me, even like Krishna, are pretty young. Like we started our investing journey since past 5 to 6 years, and unfortunately missed that. I very wisely choose the word unfortunately because we haven't properly seen the bear markets in small cap and mid caps. But there are there are more horror stories to these segments. So, do you think that having a portfolio that supports normal large caps and semi large caps with mid and small caps in a longer run enhances the returns? like what has your experience been, if I have to say, because there are these lot of ghost stories, especially for small caps and mid caps, the way it went in 2000, the .com bubble, as they say, and even in 2000 and the way it bursted in 2007 and 2000.
Right. So I think the fund structure that you're referring to is more like of a multi-cap sort of a structure, where there is an allocation to large caps, mid caps, and small caps. It sort of has a good sort of mix of all the three sort of segments. So I mean, I think in again, like the point to point comparison, if you take, like, the drawdown might be much lower in them.
Yeah, my question was, when we invest in a particular small cap and on the basis of some triggers, but somehow the thesis does not play out. So, like,
Right.
till what time do we wait, as there is always an opportunity cost for the same?
I mean, it's really. I mean, I'll give you an example. Okay, now you take India's greatest investor. Okay, Mr. Junjunwala. Right now, he had invested in Titan. He invested in Titan when, for 3 years the stock traded flat, right? But after that, I mean, you've seen. I mean, like it. I mean, today it's made him. I mean, it's one of the reasons why he's considered one of India's greatest investors, right? So I mean, there's no right and wrong answer to sort of your question. It's really relative. It really depends on your persona. But in our specific case, because we're managing public money, obviously, there is a certain threshold. I mean, so every quarter or so, we do evaluate all our positions to see how they're performing, or is there a chance of capital loss, or something like that. So we do keep evaluating it, and if there is something which is substantially better than what we're holding, then we may replace it. But again, it's a very context specific decision. I mean, that you have to take.
Okay, thank you, got it.
Vaibhav, I have a quick question. How do you look at the cash component of your portfolio? Like, do you have a certain allocation to cash?
No, we don't have any cash component in the multiplier portfolio as of now.
All right. Thank you.
So we're having a bit of trouble pulling the next person up. In the meantime, we have two questions. One was about you've mentioned Snowball as one of the books that has had a large meaningful influence on your investing journey. So if you had to, in a Snowball fashion, describe one or two of your biggest wins, how would you do that? I mean, would you do that for us?
So I think like one is Snowball. Like, obviously highlights Warren Buffett's sort of successes, but it also highlights, I think, his like some of, like, it sort of gives you the context behind all their decisions. And I think to get the context behind all the major decisions of probably one of the world's greatest investors, I think that's a very rare sort of a. I mean, it's sort of very rare, because I mean, he himself is sort of speaking through it as well. So I think it's sort of a freely available sort of wisdom handbook for anybody. I think specifically coming to my wins, I think so again, I think, like, one of the stocks that we had talked about earlier, which is Dixon. So for me, that was a company that sort of done very well. And I think more recently, I'd invested in a company called Angel Broking. I think some of you might be aware of it. So I think they, for example, have transitioned from a complete traditional broker to a completely sort of online digital DIY sort of a platform. And I think that's where they've sort of done very well. Yeah, I mean, I think there are a few other stories as well, but I think these two sort of would be, I guess, good things to highlight.
Can you talk a little bit about your mindset and your process going into these two investments?
I think, again, Dixon was sort of one company where it just seemed like one of those companies where, again, like the opportunity size in electronics manufacturing was sort of quite large, and I think it was available at sort of reasonable valuations in 2020. So at that time, both the opportunity size and the valuation sort of played out in my favor. And I think for angel broking, I think because like I'm in the capital market space, it's a space that I look at closely. We could see sort of angel broking sort of growing exponentially. So I think given their track record in doing that, we invested early on, and then we sort of reaped the benefits of that.
Cool. Sahir, you had one?
Yeah, nice, Vaibhav. Lovely hearing about your wins. Had a contrary question. Had a question about some mistakes, and you'd mentioned in the beginning how back in 2007-8, not holding Nestle was kind of a mistake, etc. Could you, I guess, walk us through like a couple of your mistakes and how you do things differently now?
Yeah, so I think there were periods I think when I might have invested. I think some of the mistakes have been made like behaviorally when I sort of came into the context that anything like when there's a bull cycle, I think you tend to think that it'll go on for a long time, and then when reality strikes, it sort of comes crashing down. So I think being aware of the context in which you're investing, I think, and sort of being mindful of that will I think help you take more rational decisions. So I think that's in terms of companies. I think one of the companies that I guess didn't do very well. I thought it might do well. Was this one? There's a company called Financial Technologies. They were the original promoters of the commodities exchange and all of that. So that company, had a complete sort of nightmare in terms of corporate governance and all of that. Like while the businesses they had set up were phenomenal, but they were the promoters of MCX and some of the other exchanges, and they in fact sort of the promoter did really badly and all of that. So I think some of those signals were there early on, but I got carried away by the opportunity on the business side. So I think that was one mistake that I had sort of made. So I think very mindful about quality of promoters, and because in India that can especially make or break a company. So I think it's important to be mindful of that.
Thank you. Got it. Thank you for sharing. Krishna, who do we have next?
So we've got Bengal, and
Hello?
then after that we've got Mayank.
Yeah, hi. Can I speak?
Yeah, go ahead.
Yeah, Vaibhav, this is more related to your application, that is Teji Mandi app, right?
Yeah, I think
I'm a subscriber to it.
That was sort of a little bit from my side.
Yeah, I am a subscriber to it.
Have more questions?
Only one problem. I have a small question. Like, one problem that I face is, say, suppose I subscribe to an app and then I go off. So you have a 6 months period. Then I took a break for 2 months. Then again I subscribe to that app. I get a series of companies which I should buy, but it shows only the current prices and not the prices that you recommended while you recommended it at the first go. Say you recommended it at say 100 rupees. When I joined that app, I see that it is 120. I don't know which is the base price that you recommended that particular stock for. So I only see 120, which is the current price. So there, I think slight showing your base price where you first recommended it would be helpful for the subscribers.
Sorry, I think I had some trouble connecting. Could you maybe please reframe your question?
Yeah, we weren't able to hear you clearly. I think also it's not super relevant to this discussion. So if you want, you can actually DM your question to Vaibhav, or to the Teji Mandi handle, and I think they will be able to address it more appropriately.
Yeah. So then you can.
I think Mayank wanted to go next.
Yeah.
But there's some glitch. Wait, I've added him again. Mayank, yeah, go ahead.
Vaibhav, I just had one query in my mind that going ahead in the medium term, where do you see the tailwinds coming in the mid and the small cap sectors? Thanks.
So I said, I think one is the capital markets. I think there's a large opportunity ahead. Second is, I think in the housing sector, and in the infra and ancillary space, and any of the ancillaries to infra and housing. And I think third would sort of be banking. So I think these are three large sectors, and then if you want to play something which is a little more bellwether, then I think IT services looks like could be very interesting.
Okay. Thank you, dear.
Thanks.
Vaibhav, because you said banking, do you think India's inclusion into the global bond index, do you think that could be a tailwind of some sorts?
I mean, so I think what that will do is that I mean, the FPI flows are very important. As far as the balance of payments and forex reserves are there. So if India's forex reserves are strong, then that will save the rupee from depreciating. So it means that the rupee will be more stable. So in that sense, I think if you have if you have strong forex reserves, and if you have like foreign inflows into India, then it also means that Indian companies are able to raise capital at very competitive rates globally. So I think it could be positive at many different levels.
Got it. Thank you.
Cool. We've got one last question from the audience, which is about AI advisors and robo advisors, and how do you feel like that trend is going to play out in India?
You said robo advisors, and which other sort of form of advice?
Robo advisors and AI advisors.
Oh,
I think
AI
they're the same
advisors.
thing.
Yeah. So I think I don't think that machines can completely replace human beings. I think if you really want to create wealth, especially in capital markets in India in a big way, I think it's going to be man and machine, and machines can sort of help you improve your decision making, or in sort of making it more efficient. But I think complete machines, then I think that sort of then goes in the realm of algorithmic trading or derivative trading, and so forth. Over there where it's a game of sort of nanoseconds and milliseconds, I think there machines will obviously outdo human beings. But in sort of long term investing, where it's a very different ball game, then I think it'll be a game more of man and machine.
Any resources you want that people should look into?
Yeah, so I think as I had mentioned earlier, I think India is sort of coming out of down cycle, and going into a sort of a structural upcycle for 3 to 4 years to come, and or many more years to come. And in fact, in such a thing, mid and small caps actually tend to do really well. And I think our multiplier portfolio is sort of well primed to sort of take advantage of that. So people should definitely consider investing in mid and small caps. I think you will sort of not be disappointed. Obviously, with some filters. And yeah, I think there are a lot of now blogs and resources online which I think you can search through Google and stuff. So that's how I would look at it.
Thanks, Vaibhav. Thanks for sharing. So I guess we're going to end the session now. Thank you so much for such a wide array of insights, especially about the small caps and mid caps that are here in our country. Also about other different things, and also thank you for answering the audience questions.
Yeah. Thank you so much for hosting me.
Yep, no worries, no worries. Guys, please check out the Teji Mandi app and please check out Vaibhav's small case. It'll be on one of the pinned tweets that we have on our either, or you can check out either Vaibhav's profile or either you can check out Krishna or my profiles. Um, there'll be a link to a small case there. And Vaibhav, is your Teji Mandi app available on Play Store as well as App Store?
Yeah, it is.
Okay, got it. Yeah. Another thank you for doing this. Really enjoyed this, and looking forward to hosting you again. Krishna,
Yeah.
any thoughts?
Yeah, absolutely. I think it was a great discussion. There was a lot of knowledge packed into 1 hour, and really looking forward to interacting more with you, Vaibhav, both online and offline.
Yeah, thank you so much for having me, and great discussing all.